In March of this year, two of the biggest names on Wall Street did something that almost nobody on the evening news talked about. Within 24 hours of each other, Apollo Global Management and Ares Management, combined, they manage hundreds of billions of dollars, quietly told their investors, "You asked to take your money out. We're not going to give it all back." At Apollo's flagship private credit fund, investors requested to pull out more than $1.5 billion. That's about 11% of the fund. Apollo paid them back 5%, 45 cents on every dollar people asked for. The rest? Locked. Try again in 90 days. Ares, same week, same cap, same message. And here's the thing. These aren't tiny hedge funds. These aren't some shady outfit on a side street. These are publicly traded, blue-chip Wall Street firms. The kind that show up on CNBC in expensive suits, telling you everything is fine. So why'd they hit the brakes? That's what we're talking about today. Because the short answer, the one Wall Street doesn't put in the headline, is that there's a $3 trillion corner of the American financial system that most people have never heard of. It's bigger than the GDP of France. It is almost completely outside the regulations you think protect your money. And the odds are very good, that your 401k, your pension, or your parents' annuity is already plugged into it. You just don't know. It's called private credit, and Wall Street's been building it very quietly for about 10 years. Let me show you what it actually is, where the pressure's coming from right now, and why the date June 30th is circled on a lot of calendars in New York. Before I throw numbers at you, let me give you a picture. Imagine your neighborhood has two banks. Bank A is a regular bank. You know this one. There's an FDIC sticker on the door. Examiners show up every quarter. The rules are posted on the wall. If you need your money tomorrow morning, you walk in, you get your money. That's the deal. Bank B is something new. Shows up about 10 years ago. No FDIC sticker. No branch you can walk into. No quarterly examiner. What Bank B does is send you glossy statements 4 times a year. Pays you more interest than Bank A. You feel smart for using it. There's one line in the fine print, but nobody reads it. It says, you can only take out about 5% of your money every 3 months. Nobody thinks about that line, because nobody tries to take their money out all at once. Until somebody does. Over 10 years, Bank B keeps growing. Doubles. Doubles again. Doubles again. By 2026, Bank B has made about $3 trillion in loans. It is one of the biggest lenders in the country. Some estimates put it higher. The Financial Stability Board flat out says the global data is so incomplete they can't fully measure it. Now here's the part where you pay attention. In March of this year, a small group of Bank B's customers, about 1 in 10, tried to get their money out at the same time. Nothing dramatic. No crisis. Just about 10% of people said, "I'd like my cash, please." Bank B said, "Here's 45 cents on the dollar. Come back in 3 months." That's what happened at Apollo. That's what happened at Ares. And here's the twist you probably weren't told. You don't just have neighbors who bank at Bank B. Your pension fund is a customer. Your life insurance company is one of the biggest customers. The retirement annuity that got pitched to your dad last year? Full of loans from Bank B. Bank B isn't called a bank. It's called private credit. And the reason it's not called a bank is very deliberate. Because if it were a bank, it would have to follow banking rules. Okay, so how did we get from 0 to 3 trillion in about a decade? Rewind to 2008. After the financial crisis, regulators looked at the banks and said, never again. They tightened capital rules. They made banks hold more cash against risky loans. They made it harder for banks to lend to mid-sized companies. The kind that don't have a credit rating, don't file with the SEC, don't fit the template. So a bunch of mid-sized American companies suddenly had trouble getting loans. And wherever there's unmet demand, somebody builds a business. That somebody was the private equity world. Firms like Apollo, Ares, Blackstone, Blue Owl, KKR. They set up new lending arms. They raised money from big investors, pensions, endowments, insurance companies. And they started making those loans that banks no longer wanted to make. At first, it was a niche, a couple $100 billion. Then, as interest rates went to 0 and stayed there, pensions and insurance companies were desperate. They had to hit return targets of, say, 7% a year. But safe bonds were paying 2. Private credit said, we'll pay you 8, 9, 10%. Come on in. And the money flooded in. By 2020, it was about $1 trillion. By 2025, $3 trillion. Morgan Stanley's estimate. Some estimates go higher. Now here's a piece of this story most people miss. In August of 2025, there was an executive order titled Democratizing Access to Alternative Assets for 401k Investors that paved the way for private credit to be included in ordinary American retirement accounts. The stated goal was to let regular savers access the higher returns that big institutional investors have been getting. The Labor Department followed up in April of 2026 with proposed rules to make it happen. Critics of the move pointed out something awkward about the timing. Because just as the door was opening to ordinary 401k participants, the warning lights in the private credit market were already blinking. Here's the thing the brochures don't tell you clearly: the fees. These funds charge management fees on the full amount they hold, not just on what they earn. $3 trillion of assets means billions of dollars of fees, every year, whether the underlying loans perform or not. The firm wins early. The investor hopes. That's the machine. Now let's look inside it. There are 3 things about private credit that, in my opinion, really matter, and that don't show up on the glossy PDF. Thing 1. The software problem. Morgan Stanley estimates that roughly a quarter of private credit loans went to software companies. Apollo's flagship fund, software is the single biggest sector, 12.3%. Blue Owl is heavy here too. Why does this matter? Because the whole pitch on lending to software companies was, these businesses have predictable, recurring subscription revenue. They're sticky. Customers don't leave. It's like owning a toll road. Except generative AI showed up. And suddenly, a lot of those software companies are watching their customers do for free, with an AI tool, what they used to charge $20,000 a year for. Their moats are shrinking. Fast. Now, if you're the lender, your loan is 3 to 7 years long. You can't get out. The borrower is on the hook for the full amount. And if their business model is getting eaten alive, well, you've got a problem that hasn't hit the books yet. Apollo's own CEO, Mark Rowan, said something interesting about this. He said, if 30% of your portfolio is in one industry, you have not been a good risk manager. He was distancing Apollo from peers, which tells you what he thinks is going on at some of the peers. Thing 2. The technique called amend and pretend. There's a phrase industry insiders use. It's called amend and pretend. It means, If a borrower can't pay, you don't force them into bankruptcy. You amend the loan, extend the maturity, waive the covenants, let them pay in payment in kind, which is basically an IOU for more debt instead of actual cash. And then you pretend nothing happened. Industry research has been pointing out that with these techniques, sometimes called shadow defaults, real default rates could be far higher than the headline numbers suggest. One managing partner at Reach Capital told CNBC that an 8 to 9% true default rate could be quietly absorbed this way without ever showing up as defaults on paper. Think about what that means. Fitch's reported default rate in early 2026 is already 5.8%, the highest in years. But that's the reported number. The real economic stress, according to some analysts, is probably worse. Compare that to your mortgage. If you stop paying your mortgage, the bank can't just quietly extend your loan by 7 years and report you as current. There are rules. Public rules. With private credit, those rules are mostly set by the firm itself. Thing 3. This is the one that hits home. The Financial Times has called the insurance industry the lifeblood of private credit. Think about that word, lifeblood. Here's how it works. Insurance companies, the ones that sell you life insurance, the ones that sell your parents' annuities, they need to earn yield to pay future claims. So they started buying private credit, a lot of it. They wrap it inside the products they sell to ordinary Americans. The Wall Street Journal ran a remarkable piece recently on who actually regulates this massive exposure. The answer isn't the SEC. It isn't the Federal Reserve. It's, get this, the Insurance Commissioner of the state of Iowa. Because a lot of these insurance companies domicile there, and state insurance regulators oversee them, which means the single most important regulator for a trillion-dollar slice of this market sits in Des Moines. Why should you care? Because of something a distressed debt investor named Andrew Milgram, he runs an investment firm called Marblegate, described to Axios as a potential doom loop. The loop goes like this. Word gets out that private credit is stressed. Retirees hear about it. They get nervous about their annuities. They start surrendering them, cashing them out early. The insurance companies, to pay those withdrawals, have to sell private credit holdings. But private credit is illiquid. You can't sell it fast without a big discount. So prices drop, which scares more retirees, who surrender more annuities. And on it goes. Industry defenders push back hard on this scenario. Apollo, for instance, argues that the vast majority of private credit is investment grade, carefully underwritten, and genuinely useful for generating retirement income. That argument has merit. Not every private credit fund is exposed to shaky software loans, and insurance companies do generally invest at the safer end. But the broader point, the one economist Eileen Applebaum made in a recent Center for Economic and Policy Research analysis, is that the market is so opaque, we can't really assess the risk either way. You can't evaluate what you can't see. Okay, but here's a question I bet you've been thinking. You said Bank B isn't a bank, that the rules are different. So where is Bank A, the regular banks, in this picture? Are they completely separated? No, they're not. Patrick Corrigan, law professor at Notre Dame, published a paper in January of this year that I'd highly recommend looking up. The title is Safekeeping Too Big to Fail Banks from Private Credit. And his central finding is this. I'm going to paraphrase carefully because it's important. The banking sector, he writes, is not merely a lender to the shadow banking sector. It is a significant owner of it. Read that twice. Here's how it works in practice. Banking organizations hold equity stakes in private credit funds. They provide subscription lines, basically short-term financing, to those funds. They have backup credit facilities. Corrigan's paper documents that depository institutions have committed over $500 billion in unused loan commitments to non-bank financial institutions. Why structure it this way? Regulatory arbitrage. If you lend through a wholly owned subsidiary, it's regulated as a bank. You have to hold capital against it. You're subject to the Volcker rule. Restrictions on affiliate transactions. The whole banking rulebook. But if you take a minority equity position in a private credit fund, the fund isn't a bank. It's not regulated like a bank. It can hold distressed debt, payment-in-kind loans, convertible debt, all the stuff a regulated bank can't hold directly. But the bank still benefits economically from the fund's performance. In late 2025, regulators, the FDIC and the OCC, rescinded the 2013 leveraged lending guidance, which had restricted how aggressively banks could participate in this kind of lending. Supporters argued this was about letting banks compete with non-banks on a level playing field. Critics argued it essentially brought the risk back into the regulated banking system at the worst possible time in the cycle. However you read the policy, here's the structural reality. What you probably thought of as two separate financial systems, the regulated banks you use every day and some shadowy private lenders off to the side, aren't actually two separate systems. They're plumbed together, tightly, in ways that are hard to see from the outside. That's why Jamie Dimon, the CEO of JP Morgan, America's biggest bank, said something last October that made headlines for about 48 hours and then disappeared. On his Q3 earnings call, JP Morgan had just taken a $170 million write-off. That was tied to the bankruptcy of a subprime auto lender called Tricolor. Around the same time, an auto parts maker called First Brands filed for Chapter 11. The Department of Justice has reportedly opened a criminal investigation into its financing practices. Court filings pointed to over $2 billion in what's been described as off-balance sheet borrowing. Dimon, talking about these two companies, said, and I'm quoting, "When you see one cockroach, there are probably more." He then said the quiet part out loud. He said, "We've been in a credit bull market since basically 2010. 15 years of easy money." And he said, "If we ever have a downturn, you're going to see quite a few more credit issues." That's not a doom prophet on YouTube saying that. That's the CEO of America's largest bank. On an earnings call. On the record. Whenever something like this comes up, somebody immediately says, "Oh, you're just predicting the next 2008. I'm not. And honestly, I want to be careful here because the differences matter. In 2008, the risk was concentrated in residential mortgages, bundled into mortgage-backed securities and CDOs. The collateral was houses, physical things you could point to. And the leverage on those structures was enormous, sometimes 30 or 40 to 1. Private credit is different. The collateral is cash flows from operating companies. The leverage on the funds themselves is generally lower than what Wall Street was doing in 2007. Most of the capital is institutional money with long time horizons, not retail depositors who can run on the fund overnight. Industry voices, Apollo, Blackstone, others, make these points consistently, and they're not wrong to make them. The structures are genuinely different. The investor base is more patient. The leverage profile is different. But here's what's also true. There's an old Warren Buffett line. You don't know who's been swimming naked until the tide goes out. The tide, for the last 15 years, has been very forgiving. Interest rates at 0, covenant-light loans, money chasing yield at any cost. Borrowers who would never have gotten a loan in a tighter era got plenty. When the tide recedes, you find out which loans were good loans and which were just hopeful. And in private credit, because of amend and pretend, the finding out can be delayed. But it can't be canceled. Which brings us to the date I mentioned at the beginning, June 30th. A large number of private credit vehicles are required to update investors on net asset value on a quarterly schedule. June 30th is one of those dates. It's the halfway point of the year. Auditors are involved. Independent valuations get pulled in. What's been quietly extended, amended, or marked to hope, it has to show up as a number on that day. Now, this might pass uneventfully. Many quarters do. Marks get updated, losses get absorbed, life goes on. Private credit has gone through stress before, in 2022 and 2023, and didn't blow up. Industry defenders have a perfectly valid argument that this is a maturing asset class going through a normal cycle. But the combination right now, record redemption requests, AI pressure on software borrowers, a newly opened door to 401k money, banks deeply interconnected with non-bank funds, insurance companies as the hidden hub, and a halfway through the year valuation date. That combination is why a lot of serious, non-dramatic people are paying very close attention. Let me leave you with 3 things you can actually do with this information. Not investment advice. I am not telling you to buy or sell anything. Just 3 ways to be a sharper customer of the financial system you're already using. Number 1. Know what you own. Go look at your 401k. Look at your IRA. If you have a life insurance policy, an annuity, a stable value fund, a diversified income fund, an alternative income allocation, look at what those are actually holding. The information is in the prospectus or the statement. It's boring reading. Do it anyway. Because if something goes bump in the night in private credit, you want to know whether the bump reaches you, and by how much. Number 2. Liquidity isn't about whether you can sell. It's about whether you can get paid when you ask. The Apollo investors who got 45 cents on the dollar in March, they technically still own their shares. They just can't access them. Semi-liquid is a marketing word. It means liquid when you don't need it, and not liquid when you do. Every product you own, understand whether the liquidity it promises on the brochure actually exists in stress. Number 3. The financial system teaches the same lesson every cycle, in a different costume. In 2008, it was called mortgage-backed securities. Today, one version is called business development companies. Before that, it was savings and loans in the 1980s. Before that, trust companies in 1907. The costume changes. The pattern is the same. Take long-duration, hard-to-sell risk. Wrap it in a package that looks short-term and liquid. Sell it to people who want steady income. Collect fees along the way. Hope the tide doesn't go out. Most of the time, the tide doesn't go out. Until one time, it does. I'm not predicting which time this is. Nobody honest can. But when Apollo and Aries hit the brakes within 24 hours of each other, when JP Morgan's CEO is talking about cockroaches on an earnings call, when the Iowa Insurance Commissioner is quietly regulating a slice of the global financial system, when a 401k door is opened just as warning lights come on, somebody is trying to tell you something. Maybe it's nothing. Maybe it's the usual noise of a complicated financial system working through the usual stress. But maybe, just maybe, it's worth knowing where your money sleeps at night. before you need to wake it up.